2021 was a good year for Ark Invest. However, it went down to 50%, which led many investors to sell the fund. Investors are now scared to invest in Ark's ETFs, and a lot are shorting it. Usually, lower prices means there's a huge return in the future, and that's why the CEO of Ark Invest, Cathie Wood, believes that people who are skeptical are not really understanding that they're at a price point where it could potentially be one of the biggest opportunities in the history of the stock market, saying that we're in a situation similar to the dot-com bubble with the roles reversed. Welcome to Empire Investing, where we'll be sharing the latest in stock market news, technology, and innovative investment strategies for aspiring millionaires and billionaires. If this is your first time here watching our channel, welcome, and please do consider subscribing to see more videos just like this. With that, let's get started. During the dot-com boom, internet stocks rose dramatically while value stocks plummeted. After the dot-com bubble burst, value stocks outperformed growth stocks. The graph on the screen compares the Nasdaq's returns to Berkshire Hathaway's returns from 1999 to 2004. The Nasdaq plummeted, but Berkshire Hathaway stock gradually climbed in value. We're in a similar predicament, according to Cathie Wood, except the roles are reversed. She compares the innovative stocks of 2022 to the value stocks of the dot-com boom and the value stocks of 2022 to the internet stocks of 1999. Although it may appear strange, the performance spread between the two funds is actually pretty close. Ark has lost around 50% of its value in the last year, whereas Berkshire Hathaway has gained more than 30%. In this last year, it has been our kinds of stocks that were hitting new lows as value stocks were hitting all-time highs. And as you know, the right thing to have done during the late 90s when the ratio behaved that way was to move away from the new highs into the new lows. And I think the same is true today, Cathie Wood. Price fluctuations are fascinating to study, but not everything that goes down has to come back up. The macroeconomic background, on the other hand, is preparing Ark Invest for a big surge. The Federal Reserve is expected to hike interest rates in March of this year, as everyone knows. In March, most economists expect a 25 basis point, 0.25% rate hike. However, others believe that another rate rise is on the way. Traders are presently putting in a 30% possibility of a 50 basis point or 0.5% rate hike. This is due to the fact that the most recent employment data was significantly better than projected. It was expected by economists that there will be 150,000 new jobs in the beginning of 2022. However, the U.S. ended up having 467,000 new jobs instead. This is a huge difference, which shows that the economy is doing well at the moment, plus the fact that the unemployment rate has maintained a low position of 4%. Jerome Powell, the Fed chair, has stated that he feels there is a lot of room to raise rates while the economy continues strong. All economists and institutions are now vying to outdo each other by anticipating ever-increasing interest rate rises. According to Bank of America, 7 rate rises are expected in 2022. A rate boost usually amounts to 25 basis points or 0.25%. So a rate rise of 725 basis points would result in a 1.75% increase, which is a fairly brave move by banks and economists. The Fed's comment that it is behind the curve on rising rates, according to Bank of America, is a harbinger of potential pain to come. This is occurring at a time when money growth is beginning to decline. On a monthly basis, M2 money, which comprises cash, bank deposits, and easily convertible money, has begun to decline. The upcoming rate hike in March, as well as the risk of future rate hikes, are beginning to be included into the Ark's values. Growth equities will be in a terrific position to gain if and when inflation cools in reaction to these sorts of rate rises. The question is, how many rate rises will be required to keep inflation under control? Cathie feels that the threat of interest rate hikes is overblown, and as a result, only a few rate hikes will be required to curb inflation. There are also other economic factors that will come to play which will influence the Fed's actions. Many people, after today's employment report, are beginning to think that 50 basis points is the number, that the Fed will basically telegraph that it means business and that it's going to head inflation off in the past. They may do that, and if they do, however, we think the stars are aligning in such a way that they will get the message very quickly that they don't need to do much more.
Another break on them is political year, the midterm elections. The Fed does not like to get in the middle of midterm elections, doesn't want to be accused of any political dynamic.
So they might want to do the 50 basis points just to say, okay, we're done for a while. Now, what's interesting about the market's reaction to this possibility is that strategists out in our world are now trying to leapfrog each other, saying, okay, I think it's at least 3 more tightenings after that, or 4. I've even heard altogether 7. So the reaction you've seen in the equity market recently is fear.
I think that the Fed is going to go too far too fast because, as I will go through in a minute, the economy is quite weak. And I think the Fed could overdo it quite quickly.
If Cathie is correct that the Fed will not have to raise rates as much as most believe, then ARK will face significant value readjustments on the upside. If the Fed hikes interest rates by 50 basis points in March, it will be a fantastic time to buy creative stocks. This is because the future prognosis for Ark Invest is good and they won't be needing to increase their rates anytime soon. Returning to Cathie's prior .com comparison, value stocks have continued to rise month after month. Even with the recent sell-off, Ford stock is still trading at a 5-year high, and banking and energy equities have also been on the rise in the last year. The Vanguard Financials Index Fund has gained 28% in the last year, while the Vanguard Energy Fund has gained 52%. These rises are clearly unsustainable for slow-growing equities. This is an indication that there is a massive bubble for value stocks based on the fear of a repeat of the dot-com boom. Ford's upward movement and valuation is a good example for the value bubble which Cathie talked about. I was very interested after Ford said that the demand for its F-150 Lightning EV was so much stronger than it's expected. Its stock exploded. Now I want our auto manufacturers to be very successful in the EV space, but to see its stock jump to highs that it had not seen since 2000 is a sense of what I just said. What that move said to me is, oh my goodness, investors don't understand that 97 to 98% of its sales base is gas-powered cars.
And we believe that the shift toward electric is accelerating here, oil prices being one reason, but also lower prices being another as battery costs come down.
So I found that very interesting in the context of the juxtaposition of the late 90s against today. Cathie Wood. A lot of investors believe that the continuous increase of the interest rates will harm Ark Invest. However, Cathie believes that the increasing interest rates will only affect big tech companies. She believes that smaller innovative companies can overcome these interest rates if it continues to go higher. If we assume a company grows at 50% per year, then increasing the interest rates by 2% will lower valuations and reduce compound interest, which wouldn't affect the company long term. However, if the growth is only at 15% and the interest rates increase by 2%, that will definitely hurt the company. A company growing at 50% per year for 10 years discounted at 10% per year would increase its revenue by more than 28 times. The company's revenue would only rise 20 times if it were discounted at 15%. That's a significant difference, but it pales in comparison to the impact of a firm growing at a rate of 15% every year. We'll be using the rule of 72 to calculate how long it takes for a number to double. The rule of 72 is basically saying that 72 divided by growth rate is equal to the number of years it takes for a number to double. If a company has 15% per year revenue and is discounted by 10%, the company will grow by 5% each year. As such, we can take 72 divided by 5, which equals 14.4. That means for the company's revenue to double, it would take 14.4 years for their numbers to double when the discount is at 10%. However, if the company is discounted by 12%, which brings the growth rate to 3% using the rule of 72, the company would need to wait 24 years for their revenue to double. Taking over 9 years to have your revenue doubled is awful for investors. This demonstrates the impact of the increasing rates for larger tech companies. And this is what Cathie's talking about. The public market is correcting their valuations while the private market is doing the opposite. This is probably because private investors are aware that the increase of rates would have a significant amount of impact on valuations. Now, I have spoken to some really good value investors, who've been doing this all their lives and asked them, if interest rates were to move into the 2 to 3% range, let's say as measured by the long-term treasury yield, which parts of the market, given where we are now, would be a hit? And the answer that I found most interesting, and I think we've just seen in Facebook, is it would be the more mature growth companies that are facing some competition and not the super growth companies that are just entering into their exponential growth trajectories. So again, another argument for new growth, think Amazon, early 2000s. If you had put into a dividend discount model Amazon's revenue growth rate for the next 25 years at 20 to 30%. say 25%, which is what happened.
That nobody believed it was possible. Then, given the way that the cash flow dynamics would have been projected, you would have bought that stock all day long as a value investor. And of course, the returns would have been phenomenal.
Cathie believes that we are in that same scenario where growth will occur, which is why she thinks that the private markets know this because there's a lot of innovation going on today more than ever. That's why people who are dumping on the ETF should be doing the exact opposite. That's why it's important to understand that the returns on the way up are greater than the negative returns on the way down. Short-term swings, according to Benjamin Graham, author of The Intelligent Investor and Warren Buffett's mentor, are emotional and counterintuitive. Graham proposed that when the market, whom he dubbed Mr. Market, becomes too exuberant, investors should attempt to abandon their positions. When investors are pessimistic, that is when they should buy equities. That isn't a simple formula and further analysis is necessary, but it's a concept that is not worthy for all investors regardless of how experienced or well-informed you are. However, Cathie could still be wrong, but there's a good chance she's right, which will make a lot of ARK investors wealthy very soon. That's all for today. What do you think about Cathie's predictions? Join the discussion in the comments below. And if you like the video, please click the like and subscribe button. We'll see you guys in the next video.